Outscale means PGIM has global resources to access the world's public and private markets for 1,500 clients in 52 countries. Join the pursuit of outperformance at pgim.com. That's pgim.com.
Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. All right, let's take a look at the smart home industry. Matt, I recently sold my house, and I only built it 17 years ago, but apparently it's not smart enough because the new buyer had his tech guy come by to do an assessment. I think they're going to do a big upgrade. I don't have a tech guy, but apparently a lot of people have tech guys.
I need a tech guy.
You need a tech guy for your house. Aaron Amy, tech guy, co-founder and CEO of Brilliant Home Technology. Aaron, thanks so much for joining us here. I guess the smart home, I know it's a big thing. Give us a sense of how big it is, how fast it's growing. What are people doing to their homes these days?
Yeah, I mean, it's the next great platform because technology advances in a series of platform wars, and we've seen that happen with personal computers, internet, and then mobile. Smart home is the next great platform, and it has rapidly grown to more than $75 billion and is taking over every home.
But so what is it? I mean, is this where like the lights turn on and off when you walk in and out of rooms? Does your stereo, like your playlist, follow you around? Does it adjust the thermostat? I don't get it.
It does all of those things, and it basically personalizes your home. So it does what you want it to do with a minimum of fuss and bother, and it opens up new kinds of possibilities. So when someone's at the door, you see who it is, and you can talk to them. You can give people permission to come into your home without having to make a key for them and the security risks that entails. And then you can automate functions. So when you're going to watch a movie or you're going to go to bed, all of the different things that need to happen, whether it's temperature, whether it's lighting, whether it's locks and so on, can all happen automatically.
So what are some of the most popular functionality that I guess people are asking for these days?
Yeah, I mean, smart locks has been a really important category of access control because there are a lot of security benefits to being able to control access remotely. Security has been a big area where you have peace of mind that your home is secure. Lighting is a very important area. Smart music is another big one. Smart climate control both saves a lot of energy and makes homes more comfortable. So all of these categories have already proven themselves to be very significant.
So where do consumers get hold of all this? I mean, Paul's home buyer had a tech guy. I don't even know where I would go to get one.
Yeah, so there certainly are some tech guys that you can get and so on. Increasingly, what we're seeing at Brilliant is new homes being built with technology in them as well. So you can buy it yourself and you can install it yourself. You can have a tech guy do it if you're not that tech forward yourself, or it simply comes when you get a new house or you move into a new apartment because the developers are increasingly building homes as smart homes.
So one of the things I'm concerned about, or I've noticed, I guess, is that the technology changes so quickly. So whatever tech you put into your house, it's out of date. 5 years later, it seems like it's got to be super, super flexible to be adaptable going forward.
It is. And that's one of the changes. And one of the things that companies like Brilliant are doing is making sure that what we're doing is extensible. So, for example, we're updating our software every 2 weeks, and the software is really the heart of the system. So your home actually gets better as you live in it. And we've already seen this in other arenas. Like if you have a Tesla car, for example, there are always software updates. And one day your car can parallel park itself. One day it can semi-autonomously drive. And that happens without having to update the underlying hardware platform.
Are you worried about these devices getting hacked? I mean, I wouldn't want, for example, somebody to be watching me through my refrigerator or whatever,
watching through the refrigerator. No, this is a really important topic, and yes, the responsible companies in this field are very, very careful about security and actually bring additional security to bear. I myself have a background in cybersecurity, and I think that we have the ability to offer much better security. For example, you don't have to leave your key under the welcome mat or in a fake rock in the garden that everyone knows what it looks like to give people access to your house.
All right, I guess that's where we're going, Matt. So when you buy your home,
I'm happy
here
to go there. I
Westchester,
want someone to do it for me.
Yeah, you'll get a guy. We'll find you a guy. All right,
Yeah.
maybe Aaron. Maybe we'll do that for it. Aaron Amy, co-founder and CEO of Brilliant Home Technology. She's talking about upgrading the homes to technology. And again, what I've noticed is the technology changes so quickly. So you look at some of those houses where they have like panels, kind of in the wall, and they don't use them anymore. The intercom, all that kind of stuff.
I got to say, I first heard about all this stuff when Bill Gates built Xanadu 2.0 like 20 years ago. So now regular people are getting what Gates has.
Exactly.
Outscale means PGIM has global resources to access the world's public and private markets for 1,500 clients in 52 countries. Join the pursuit of outperformance at pgim.com. That's pgim.com.
Let's get to the vaccine mandate for federal employees. It looks like President Biden is set to announce a vaccine mandate, and we have Josh Wingrove, who's broken the story. Josh, what are we looking for?
We're going to hear from him at 5 p.m., probably going to get some more details beforehand. But to rewind to July, they set a rule that you had to be vaccinated or you had an option to sort of do testing and masking and that sort of thing. Now he's expanding it, sort of taking away that option B. So you have to be vaccinated, and he's expanding the number or the scope of the federal contract workforce that it applies to also. Previously was aimed at on-site. So essentially more people being covered by this without an option to, instead of get a vaccine, get regular testing and masking. So obviously many details still TBD. You would expect pushback or legal challenges potentially to this. We don't know when this would take effect. We don't know what it would mean for, let's say, a federal worker who showed up on that day without being able to demonstrate vaccination. So definitely a moving target on this one, but a substantial expansion of the vaccine requirement for federal workers.
It's interesting, Josh. Do you know roughly how many people we're talking about here? Like, it's not all federal employees. It's just executive branch employees plus federal contractors. That still sounds like a lot of people to me.
Yeah, I think we're talking millions of people, but the exact number, we don't know. And I think the question that I have right now is are we going to see pushback from labor groups? Are there going to be legal challenges or arbitration, grievances, these kinds of things filed? Potentially. But the White House broadly views these sort of, a la carte mandates, pretty big one for them as a federal government, but, for smaller companies who are doing the same thing, as a good way to sort of spur vaccination rates. People sort of, don't want to be ordered by the government to do it overall, but if your employer requires it, there's evidence that leads to an uptick in vaccinations. But, of course, the concern on the flip side is that it might generate blowback or, get people's back up, that kind of thing. So, broadly a lot of moving parts on this.
Especially, it's almost like they're trying to antagonize the Trumpian anti-vaxxers. We know that 15%, maybe more, are vehemently opposed, right?
It's different camps, right? You got hardcore anti-vax people. You got people that can't be bothered. You have people that have barriers, like they don't have paid time off to go get it, that sort of thing. I think it's worth noting that vaccine hesitancy has been declining in the U.S., not maybe as fast as other countries, but it's been going down. And we now have, 75% of U.S. adults with at least one shot. That's a fairly big number. And, they had shot for 70% in July. They hit it in August. They're now at 75%. The problem, of course, is with Delta, you might need to get quite a bit higher than that. And of course, there's a whole segment of the population, those under 12, that aren't eligible for a vaccine yet, are probably weeks or months away from being eligible. So, absolutely, if you're a diehard anti-vaxxer, this is probably not going to change your mind. But there's folks in the middle, essentially, that aren't vaccinated, that have questions, maybe haven't gotten around to it. That I think they're sort of hoping that mandates at the employer level, in other words, your job making you do it, will have a difference.
Yeah, Josh, that's the big take story of the day that Matt and I had. We were talking about this morning, focused on corporate mandates. Does a White House hope or anticipate that by taking this aggressive federal policy that they will maybe coax or urge or prod some big corporations to kind of follow suit with vaccine mandates?
Yeah, absolutely. They're sort of hoping people join the parade behind them. And this big wave started, you'll recall, with the approval of Pfizer's vaccine. Remember, for months we were using it only on an emergency authorization. When the FDA gave full approval, Biden's administration took that as a real sort of turning point to start saying, okay, corporate America, look, it's not an emergency authorized vaccine. This is now an approved vaccine. So you're on stronger footing, morally, legally, what have you, to be able to require vaccination. So I think we're going to expect to hear him call for that this evening, beat that drum. We also expect him to give an update on boosters. Remember, they plan to start booster shots in a week from Monday, maybe more on testing, a couple other elements on schools. There could be some, news, if you will, in this speech. But broadly, I think he just wants to kind of sweep together what they've been doing over the summer to try to curb this thing as those cases rose.
But so far as we know, this is only a requirement for the two vaccine shots, or is it? Will they require 3 now? Or?
That's a good question. Right now, they consider 2 to be fully vaccinated. But that's as of now. So presumably that may change. But that is a huge open question right now among researchers about what will happen. And of course, those folks that got that Johnson & Johnson shot, something like 14 million people in the U.S., they don't know what they're going to do for booster shots, and they're considered fully vaccinated after 1 shot. So this. A lot of questions still to be answered. We expect to have some clarity in, the afternoon, either around the speech, perhaps before the speech, on what exactly they're proposing. And as I say, I'm expecting a bit of a wave of statements from labor groups and what have you, saying, responding to this, about their members potentially being forced to do this. And we just simply don't know the what if kind of factor. If someone shows up, are they fired? Are they furloughed? Are they sent home? Are they, work from home?
Yep.
What is the deal? We don't know.
That's going to be fascinating. All right, we're going to get more details coming throughout the day. You'll have, and your team, lots of reporting there, I am sure. Josh Wingrove, White House correspondent for Bloomberg News, joining us on the phone from Washington, D.C. Again, green on the screen yet again, at or near all-time highs, as we continue to hear that from Greg Jarrett in his reporting seemingly on a daily basis. It's just, for a lot of folks, this feels like a market and looks like a market that is priced to perfection and might have some vulnerability into it, but that's not stopping this market. Let's check in with an expert who knows this stuff. Lisa Shallett, Chief Investment Officer for Wealth Management at Morgan Stanley. They have $1.5 trillion with a T in assets under management. Lisa, thanks so much for joining us here today. I guess I'll start with kind of the wall of worry kind of question or topic here. How concerned are you about this market, given some of the headwinds that, folks rightfully point out, whether it's rising interest rates, tapering, and, just the Delta variant? How do you view this market right here?
So look, we've been on the record, to say that this is a market that, for the most part, while it can claim that it's climbing the wall of worry and certainly positioning in, the mega cap tech stocks, it suggests an element of defensiveness. Our sense has been that this is a market, that is shrugging off most of the concerns, whether it is, disruptions coming from Delta variant, whether it's, supply chain concerns, whether it's been the China regulatory crackdown, or, shifts in policy from the Fed. Nothing really has gotten in the way of this market. It's notable, I think, that for much of the period, after the first quarter, many folks were saying that the market was rallying because interest rates were falling. Really over the last month or so, we've seen the 10-year back up from its ultimate lows on the 10-year of 117. We're back up here into the mid-130s on the 10-year, and even that has not, interrupted this grind higher in markets. So,
but you expect a pullback, right, Lisa? You expect a 10 to 15% correction before the end of the year.
Yeah, we do, and the reason for that is essentially twofold. So, with that move in rates, we ultimately think that price-earnings ratios, especially on those most expensive stocks, should compress. We've seen PE multiple compression in many, many other parts of the market, whether you're talking about international stocks, you're talking about value stocks, more cyclical stocks, you're talking about the small caps. This is the one area of the market that has remained immune so far, and there's just no precedent for that, historically. When rates go up, ultimately PE ratios do come down. So we see that as a risk. And secondarily, we're seeing folks talk about the growth scare. We're seeing people downgrade their estimates for third quarter GDP growth. Even at Morgan Stanley, Ellen Zentner has cut her third quarter number from 6.5% annualized growth rate to a 2.9%. That's a pretty big cut. Yeah. And yet folks, don't think that's going to harm earnings in the third quarter. And we think that could be another negative catalyst. So, lower PE ratios and potentially earnings disappointments or fewer positive earnings revisions are the two catalysts that might unleash that 10 to 15% correction.
So with that type of correction between now and the end of the year possible, are you suggesting people raise cash? Are you suggesting they rotate into just maybe more cyclical names? How do you think people should position themselves for that?
Yeah, so we're in the camp that says this is about rotating and actively managing. So we are buyers of consumer services, of financials, of some of the industrial cyclicals, some safer healthcare names, and some staples. It's just really some of these long duration oriented secular growth stocks that we just think are long in the tooth and need to kind of take their hit. So we're rotating here. No need to panic and go to cash and get paid nothing and even negative returns after inflation. But we do think that we're in a bull market. It's just a bull market in things other than the S&P 500 index.
How important is the infrastructure bill, or how important is fiscal, trillions of dollars in continued fiscal support?
Our perspective is that it's not so much the dollars, because what people forget is that a lot of this is going to be spent over, multiple years, if not a decade. And so on any annual basis, it's fractions of percentage points of growth. But it's really the shift in mindset that we are in a more fiscally active environment, and that is growth oriented, and so we are constructive broadly. I don't know exactly what the form of final legislation is going to take, given all the puts and takes of this, but we do think we're going to get something, and that something on the margin is helpful.
Lisa, great to get your take. Thank you so much for joining us. Hope we can get you back on soon. Lisa Shallot is the Chief Investment Officer for Wealth Management at Morgan Stanley. Obviously, very important view to get. So yeah. Always good to hear from Lisa. We are seeing continued gains in the markets right now. And as we heard earlier from Dave Wilson, we see the S&P 500 led by energy, financials, and materials. This is Bloomberg.
Today's episode is sponsored by The Motley Fool. The Motley Fool believes that long-term stock investing is the single best way for people to potentially gain what could be truly life-changing wealth. But maybe you'd like some help along the way, and that's where The Motley Fool comes in. When you become a member of The Motley Fool, they'll send you 2 new stock picks each month. Plus, you gain access to their entire library of reports with expert analysis on the fastest-growing industries. Financial freedom could be right under your nose. And today, The Motley Fool is offering its top stock picking service to new members for just $99. Visit fool.com/save. That's fool.com/save to access this special offer.
Now let's get it over to Nathan Shetty. I told you we're going to be joined by the head of multi-asset at Nuveen. They've got $1.2 trillion in assets under management. We're going to talk about the opportunities and risks in private markets. Where do you start when, Nathan, when analyzing such a huge universe?
Thanks, Matt, Paul, for having me on. It is indeed a massive universe, and I think it's only growing. We've seen a ton of interest in private markets, and I think this has been driven really by two phenomenon. The first is this lower expected return environment, at least on a go-forward basis, and I'd argue the second one is partly driven by the volatility we're seeing in economic variables and broad indicators. So investors are moving to private markets in order to incorporate them in their portfolios for more diversification. They're trying to eke out every basis point of return that they can, and that illiquidity premia is certainly one place to source it.
So it's interesting, Nathan, we hear a little bit more, I guess, really over the last several weeks and months about private credit. And I guess that's simply, investors looking anywhere they can for yield. Give us kind of the risk return profile as, you guys go out from, maybe, looking at treasuries or looking at public corporates to going out into the private credit market. Give us a sense of the risk return that you guys think about.
Yeah, private credit has just absolutely exploded, and part of that is due to some of the bank regs, et cetera, and ultimately syndicated loans haven't had the same level of supply that we've seen in the past. So private credit's stepped in there and really have a risk return profile that's not dissimilar to their public cousins, meaning syndicated loans, but at least on the middle market lending or senior secured side, we're looking at high single digits and, a lower risk profile than you'd see in public markets. And again, part of that is due to that illiquidity risk premium that you're getting. I think another reason why private credit is of such interest is you're sitting higher in the cap structure. Private equity or VC has always been part of portfolios, but with private credit, you're sitting higher up in that cap structure, have to deploy less risk, but again, a very attractive risk return profile, particularly for income-oriented investors.
So how much do things like Fed policy matter to private markets? How quickly do you see follow through?
I mean, look, Fed policy matters for all markets, public or private, and it depends on the private market we're talking about. Some are going to transmit or reverberate in those private markets quicker than others, particularly those that are sensitive to fixed income. We were just talking about private credit. Most of private credit is in LIBOR plus type lending or floating rate structures. So you have some ability to manage that rates duration risk, which is really going to reflect Fed policy much more so than you would with public market rate sensitive assets. And those are obviously going to be reflected immediately. In the private real asset space, not dissimilar. Funding rates, credit spreads, they all are going to have an impact on demand and ultimately the ability to purchase and supply in the real asset space. But the implications and that transmission from shifts in Fed policy are going to take some time. They're going to take multiple quarters, and ultimately, I guess that goes back to why we've seen such a huge uptick in demand and interest, is to mitigate some of that volatility around economic variables and that volatility around policy uncertainty. It gives it time to digest and ultimately reflect more fundamentals going forward.
Nathan, we're presumably heading into, there is inflation in this economy. Nathan, the discussion, I guess the debate is whether it's transitory or there's something more longer term. How does your portfolio, a portfolio that has a lot of, alternative assets, private market investments, private credit investments, how does that typically fare in, a inflationary, perhaps rising rate environment?
Thanks for the question. And obviously inflation is top of mind for all investors right now. It's re-entered the conversation it does exist. There's supply chain issues, and we can argue round and round about its transitory nature. We do believe that it's going to settle at a level that's higher than we've seen in the past decade, this disinflationary decade. So in a portfolio the size of ours, in a portfolio that is highly diversified, traversing public and private markets, the big area where, say, an uptick in inflation is going to influence the portfolio is in the bond equity correlation. I mean, people hold bonds in their portfolio
Right.
As a diversifier against equities. When we enter higher inflation regimes, we see that correlation tends to flip.
Yep.
I mean, this dynamic of correlation, that 30 years ago, it was positively correlated. So for us,
Right.
it's very much about finding diversification.
Gotcha.
We need to find diversification. Real assets and private assets do provide that diversification that we're seeking in those environments.
All right, Nathan, thank you so much for joining us. We really appreciate it. Nathan Shetty, head of multi-asset at Nuveen, talking to us about the private market alternatives in a portfolio. This is Bloomberg.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.
Outscale means PGIM has global resources to access the world's public and private markets for 1,500 clients in 52 countries. Join the pursuit of outperformance at pgim.com. That's PGIM.com.